Have you ever wondered about the financial instruments in the oil and gas industry, how they function, what types exist, why they are necessary, what are their advantages and disadvantages? Today we're going to delve into these intriguing questions. We'll simplify the complex world of financial instruments in the oil and gas industry and help you understand their significance in the global economy. So, what exactly are these financial instruments? In simple terms, financial instruments are contracts between parties that can generate assets for one entity and liabilities for another. They are the lifeblood of the oil and gas industry, facilitating trade, hedging risks, and allocating resources efficiently. Broadly speaking, there are two types of financial instruments in the oil and gas sector: equity-based instruments and debt-based instruments. Equity-based instruments represent ownership in an entity. They come in the form of stocks or shares. If you own a share in an oil company, for example, you own a piece of that company. You're entitled to a portion of the company's profits and have a say in its operations. On the other hand, debt-based instruments represent a loan made by an investor to the company. Bonds are a classic example. When a company issues a bond, it's essentially borrowing money from investors with the promise to pay it back with interest. Now you might wonder, why are these instruments necessary? Well, the oil and gas industry requires massive capital investments. Financial instruments provide the means to raise this capital. They allow companies to finance their operations, manage risks, and plan for the future. The advantages of these instruments are numerous. They provide liquidity, allowing companies to convert assets into cash quickly. They also offer a way to diversify investments and spread risk. Plus, they enable companies to lock in prices for future transactions, reducing uncertainty. However, these instruments are not without their drawbacks. They can be complex and difficult to understand. There's also the risk of price volatility, especially in a commodity-driven industry like oil and gas. And if not managed carefully, they can lead to significant financial losses. So there you have it, a simplified guide to the financial instruments in the oil and gas industry. They are more than just contracts. They are crucial tools that power the industry, facilitating trade, managing risk, and driving growth. But like any tool, they require careful handling to avoid potential pitfalls. Remember, understanding these instruments is not just for industry insiders. It's for anyone interested in the global economy, as these instruments play a vital role in shaping our world. So the next time you fill up your tank or switch on your heater, remember the intricate financial dance that makes it all possible. Until next time, keep questioning, keep learning, and keep exploring the fascinating world of finance.